Good afternoon, and thanks everyone to joining us today. I'm Amanda Iacone, accounting reporter for Bloomberg Tax, and I'm joined by Julie Bell Lindsay and Scott Flynn, who are here to dig into some of the trends and challenges facing U.S. corporations and possible audit implications. Julie is the Chief Executive Officer of the Center for Audit Quality. She joined the CAQ from Citigroup, where she was the Managing Director and Deputy Head of Global Regulatory Affairs. She previously served as counsel to former Commissioner Cynthia Glassman at the SEC. Scott is KPMG's Vice Chair of Audit. He leads a team of 900 partners and 7,000 audit professionals. He spent much of his career working with multinational companies and previously ran the firm's Board Leadership Center. Welcome to you both.
Thank you. Nice to be with you.
Julie and I, just a quick programming note, Julie and I are both in Washington, D.C. today, where we are experiencing some rather nasty thunderstorms. Hopefully they won't interrupt our live stream, but you might hear some thunder and rumbling in the background. So now to the main event. The Center for Audit Quality recently released a survey of audit partners from among 8 of the largest firms, looking at how economic trends, climate reporting, and more is affecting corporate strategies and priorities. Let's start first with climate reporting. Bolstering ESG or environmental, social, and governance reporting is a short-term priority for many companies, but partners cited a variety of challenges that they see for ESG reporting. Among those pain points is data. Scott, what are firms and your clients doing to address data collection challenges related to ESG reporting, especially with new SEC climate disclosures on the horizon?
Well, Julie, I think would you like to take data and then I'll talk about some of the staffing? Is that okay?
That would be great. Yeah. So I'll start, if it's okay, Amanda. I'll
sure,
cover
absolutely.
The data collection, and then I certainly think Scott can provide some views on how firms are gearing up for what could be final rules. So as you noted, our survey responses indicated there were really 3 areas that public companies are gearing up or struggling when it comes to the coming climate reporting, ESG reporting. The first is the data collection, but related to that was also expertise in this information, and also just the diversity of the standards and frameworks that are out there. Now, I will say, I believe the SEC's proposal on climate and ESG did go a certain extent to harmonizing or at least solidifying or pinpointing these standards and frameworks that could be used, which is certainly something that the audit partners reported would be very helpful. I think until we have final rules, audit partners are very much working with companies to look at the controls, look at the procedures, look at the processes and systems to understand how this data can be collected, and ultimately working with companies to make sure that if there will be assurance on this information, what type of evidence is going to be necessary to support the overall assurance opinion. So maybe Scott, I'll come to you on the gearing up.
Yeah, no, I'll certainly speak to KPMG and what we're doing. So from the standpoint of staffing up and training the people that we expect we're going to need. So we've announced we're going to spend $1.5 billion globally to expand our ESG capabilities with a collaboration between a couple of schools, NYU and the Stern Center, and then University of Cambridge. And it's really with a goal to explicitly train everybody on ESG. So the collaboration with NYU has resulted in kind of a co-creation of a sustainability program for our professionals through executive education. So it's basically a 15-hour course that's designed to provide a baseline in sustainability issues and assist our professionals in developing knowledge, skills, perspectives that we think they're going to need to understand and address environmental and social challenges. So we've had over 600 professionals that have taken the course since October of 2021, and we're now rolling this out globally. So we've got an ESG education curriculum roadmap, which is really all about designing up skills, and that's not just audit, by the way. So we feel like it's important for tax and advisory as well. And the other thing is leaning into a center of excellence. So we know we're not going to get everybody to scale immediately. And so as we build out the foundation of a group of professionals that have heightened levels of skills, we think the COE is the best way to do that. So, and that, by the way, that training is across the GHG protocol, about TCFD, and all of that's being incorporated into the curriculum. And just for some context, firm-wide, between our partners and our professionals, there have been over 30,000 hours of training delivered in the last 9 months. And I certainly expect that pace is going to continue to accelerate. So obviously just gives you some idea of the lift, expected size of the lift that we anticipate. And then in addition, from a technology perspective, needing to incorporate our ESG assurance work into our global smart audit platform is also a really big undertaking. So lots of things going on.
I wonder if you can talk a bit more, Scott or Julie, about the tools that you'll need. I mean, you mentioned adding assurance into your global audit tool, but companies also need tools to collect all this data, especially those that haven't been doing too much of this type of reporting in the past. What kind of tools are they needing? Where are the gaps there?
Maybe I can start, Scott, and if you would like to add. I would say that companies are, in certain respects, reporting some of this information. Assurance is being provided currently on ESG-related information, including greenhouse gas emissions. Now, is it in the 10Ks? No, not normally, and it's at a much lower scale than what you would have under an SEC final rule in this area. I think companies are familiarizing themselves with what the GHG protocol will require, TCFD, thinking about the gap analysis, as you mentioned, and then working with auditors and others, the audit committees, the boards, to discern where they may need additional talent, where they may need to build out additional controls, really to support all of this information and collection of it. Like I said, I do want to stress that assurance is being provided in certain areas of ESG already, including climate, greenhouse gas, but also other areas like diversity, water usage, employee workforce issues, safety, those types of things. So it's not like we're starting completely from scratch.
I want to turn from ESG data and technology to cybersecurity. The risks of hacks and breaches are both an economic and a governance risk for issuers. What shifts in cybersecurity risks are auditors seeing their clients deal with this year, and how could that impact their clients' financial reporting?
And Julie, when I start, and certainly you can add on to this, but if you just look at the survey data, Amanda, the 39% of the audit partners who responded cited cybersecurity as the single top economic issue facing companies in the next 12 months. There are nuances around all this, so certainly in terms of perceived cybersecurity risks. So if you look at, if your primary industry was financial services or technology or telecommunications, media, entertainment, then you definitely it was in the top 3. I think with respect to the risks themselves, clearly, I think phishing attacks and payments made by bad actors to insiders for login credentials, we're continuing to see that in earnest. But we continue to also see an increase in cybersecurity risk that's introduced through vulnerabilities in vendor-provided software and tools. So, if you think as companies look to software vendors for technology solutions to manage and control their systems and kind of drive efficiencies, then their cyber risk footprint becomes, in part, dependent on the cyber risk management and control and the tools provided by those vendors. So from an audit perspective, our responsibilities haven't changed. The standards require us to obtain an understanding of how the company uses IT and the impact of IT on the financial statements. And that includes understanding the extent of companies' automated controls as they relate to financial reporting, and then the IT general controls that are important around the effective operation of those. So, as we assess the risks of material misstatements in the financial statements, and that includes IT risks resulting from unauthorized access, then we're required to consider our understanding of the company's IT system. So no change there, but it's in a very important consideration, obviously.
Yeah, and I would just add, Amanda, that the Audit Partner Survey indicated that audit partners had seen significant improvement in movement in certain aspects of cybersecurity matters, like company management communicating to the board of directors on cyber issues. The partner survey also identified, however, some areas for improvement, which were cyber disclosures, managing cyber risks, aligning the company's goals with the cyber strategy. So there are some areas of improvement, but there were some areas where we've already experienced some improvement in this area.
It's obviously an important one. I want to turn to another emerging topic. For some companies, it is a risk, and that is cryptocurrency. Few partners said their clients were planning to accept cryptocurrency as a form of payment, and that sort of perceived lack of market adoption was one of the reasons that U.S. accounting standards centers have delayed drafting specific rules for digital assets until very recently they added a project. Scott, I wonder, what effect does this lack of clear accounting rules have on players looking to enter this emerging market? I mean, would clear accounting rules make a difference in adoption of this new form of asset?
Yeah, so Amanda, just to take a step back on what we're seeing, right? You alluded to some of it. So clearly, companies are entering that ecosystem, and you said it includes purchasing and issuing their own NFTs across a variety of sectors. And by the way, it's not just financial and tech; it's non-financial and non-tech, and investing in crypto and considering other steps towards the ecosystem like stablecoins. So let me just, from an audit standpoint, and then I'll come back to the whether I think the accounting update or rules are important and to get clarity. So from an audit standpoint, I would just say the things we're worried about, the challenges around certain assertions that CPAs need to think very hard about, I think, and consider a number of things differently from a typical accounting transaction. So if you think about existence, reliance on blockchain, rights and ownership, and things like key controls, valuation. And so when you think about how new that digital market is, there is a lack of clarity regarding regulation and jurisdiction in some cases. And I personally do believe that regulatory uncertainty poses risk to those companies that have started to engage with digital assets, and that clear accounting guidance could be useful for public companies holding or otherwise engaging with digital assets. So, and certainly in my conversations with our clients, I know they would welcome regulatory clarity and standard setting in this space. So, yeah, I do think that to answer your question, yes, further clarity would be really important for companies embarking on this journey.
I wonder what sort of guidance might be needed in the short term. We've had a little bit of guidance out from the SEC. The AICPA has put out some application guidance. I mean, is there a need for short-term guidance while the Financial Accounting Standards Board crafts those digital asset rules?
Yeah, I don't. So short-term guidance, no. I think very thoughtful guidance, definitely. And I think for, as you think about the marketplace, certainly for us, the things that we need to think about are just, as companies embark on this, make sure we've got the right teams. The composition and skills are, I think, critical. Finding specialists in this space to help companies navigate this around cryptography, technology, valuation. And I think it's just, there's a training element here in lieu of standards about audit teams that are interacting with people that are, may not be accustomed to outside of finance. So folks, IT tech, who may be less familiar with audit procedures and support, and therefore, in lieu of the standards, I think there are things that we as audit firms need to lean into to try and help support until regulation does come out.
We're just about out of time. Any final takeaways from the survey, Julie, that you'd like to share?
I think overall, the economic outlook coming out of the Audit Partner Survey, this was our first survey that we have done. We plan to continue to do it going forward. But generally, the outlook for the economy was not very positive. And 16% were concerned about or were positive on the economy. The rest was negative to neutral. Now, granted, this was done mid-May. Things have changed. As you know, things are rapidly changing with legislation, with developments, and reports coming out of the U.S. government. So I do think it will be very interesting to see, as we continue to do these types of surveys, how the trends, where the trends align and where we go. I do think public company auditors have unique insights into pretty much every industry, every public company, no matter how big or small in the US. And I think they, as part of their work, do risk assessments on companies and are able to see both the economy, corporate reporting trends, business transformation issues, and I think it's a very valuable data source for the capital markets.
We look forward to reading those. If you haven't checked it out, you can find it on the CAQ's website. That'll do it for us for today. Thanks again to Julie and Scott, and to all of you who joined us this afternoon. Thanks so much for tuning in. Have a great day.
Thank you.